If you have more than $1.2 million in a traditional 401k today, the IRS will force you to withdraw roughly $50,000 from that account every year, starting at age 73, whether you need the income or not. That mandatory withdrawal lands on your tax return as ordinary income, stacks on top of Social Security, and if the combined number crosses $109,000, your Medicare premiums jump automatically. That's the part the financial advice industry forgot to mention when it told you to max out every year. 401k plans held $9.3 trillion as of June 2025. That is an enormous pile of money. And the conventional wisdom that built it, max your 401k every year, no exceptions, is not wrong in the way most finance criticism is wrong. It's wrong in a more specific, more expensive way. It optimizes for one number, your account balance, while 3 other numbers run quietly in the background for 30 years, waiting for you to turn 73. Today, I want to walk through all 4 numbers, not in the abstract, with real dollars, real tax rates, and the real sequencing of how this goes sideways for people who did everything right. I'm also going to give you the order of operations. I actually use the stack that financial advisors mostly don't explain because it requires more than a bumper sticker. And I'm going to show you why, past a certain contribution threshold. Blindly maxing the traditional 401k can leave you materially worse off in retirement than a different deployment of the same dollars. Here's the frame I want you to carry through this entire video. When you contribute to a traditional 401k, you are not avoiding tax. You are deferring it to a future date at a future rate that neither you nor anyone else has agreed to yet. The IRS is a silent partner in every dollar you put in there. They own somewhere between 22 and 37% of it, depending on your marginal tax rate at withdrawal. The deal you're making is, pay me later. The question the conventional advice never asks is, are you actually going to pay less later? Or have you built an account so large that the forced distributions at 73 will push you into the same bracket or higher? I'm calling this the open tab. You're in the restaurant, the food is good, and the bill keeps growing. You can't leave until you're 59 and a half. At 73, the waiter shows up regardless of whether you ordered anything else. And the price of everything on that tab was set by a tax code you have no control over. That metaphor is going to return throughout this video because it explains every mechanical problem I'm about to walk through. In a few minutes, I'm going to show you what happens to a specific type of disciplined saver at age 73. But first, here's why the fee structure of your 401k is more broken than you probably realize, and why that brokenness is almost entirely invisible. A US Government Accountability Office study found that 41% of American workers are unaware that 401k plans carry fees. Not low fees, not high fees, any fees. Close to half the workforce believes the account is free. It is not free. On average, 401k plan fees range from 0.5% to over 2% of plan assets yearly. That range sounds modest until you run it through 3 decades of compounding. The ICI, analyzing fee impact data over extended investment horizons, found that a 1% difference in annual fees costs approximately $469,000 over a 30-year career on a $200,000 portfolio with $10,000 in annual contributions. $469,000, not from bad picks, not from market crashes, from administrative friction that never appears as a line item on your statement. That's more than twice the original balance going to fee layers that many participants aren't fully aware of. The reason it's invisible is structural. Administrators don't send bills every year to demonstrate how much you're paying. They also don't itemize fees on statements. Instead, fees are shown through the plan's reduced net returns. Your statement says the fund returned 6%. The fund actually returned 7%. The rest went to the plan structure. The Department of Labor modeled this explicitly in their fee publications. Assume you are an employee with 35 years until retirement and a current balance of $25,000. If returns over the next 35 years average 7% and fees reduce your average returns by 0.5%, your account balance will grow to $227,000 at retirement, even if there are no further contributions to your account. At a clean 7% with no fee drag, that same balance grows to approximately $267,000. $40,000 consumed by 0.5% of friction on a starting balance of $25,000. Now scale this to a realistic career. Over a lifetime, fees can cost a median income two-earner family nearly $155,000 and consume nearly 1/3 of their investment returns. 1/3 of investment returns gone, not to the market, to the structure of the account. And here is the pattern interrupt that should change how you look at your plan's fund menu. A study examining more than 58,000 corporate 401k plans, analyzing fund performance data from 2015 to 2025, found that more than 99% of all corporate 401k plans offered investors at least one fund that had a cheaper alternative that performed better over 3, 5, and 10 years. More than 94% of corporate plans had at least 3 funds that underperformed cheaper alternatives during these time periods. More than 85% had at least 5 underperforming funds, 99%. The standard fund menu inside your workplace plan is statistically almost certain to contain expensive underperformers. Not because your HR department is malicious, because the 401k industry runs on revenue sharing arrangements, on something called 12 bone fees, on sub-transfer agent charges that redirect money from your compounding balance to the intermediaries who maintain the relationship with your employer. Revenue sharing is one of the most common hidden charges in 401k plans. This happens when mutual fund companies share part of their management fees with your plan's record keeper or administrator. This arrangement can add 0.25% to 0.75% annually to your costs without being explicitly disclosed. Plan size matters too. The 25th edition of the 401k Averages book, released in 2025, reported that a $5 million plan has average costs of 1.08% in total, including 0.37% in advisor compensation, while a $50 million plan has total average costs of 0.76%. If you work for a smaller company, you are paying a small plan premium that has nothing to do with investment quality and everything to do with the economics of plan administration. Now here's the thing about fees that makes them the second most expensive problem in this story. You can actually solve the fee problem. You can push HR for better options. You can find the lowest cost index funds in your plan's menu. You can roll an old plan into an IRA with Vanguard and pay 0.03% in expense ratios. Fees respond to information. They are a known, calculable, manageable cost. The second layer of the open tab is different because it's not about what you're paying today. It's about the bill you've agreed to pay at a future date with a future rate that compounds against you while you're not looking. Stay with me, because what I'm about to show you is the specific mechanism by which disciplined, successful savers end up in a worse tax position in retirement than people who save less but structured their accounts differently. I want you to hold on to a character. I'll call him Dave. Dave is 52. He's been maximizing his traditional 401k for over 2 decades. He never missed a year, never tapped it. His current balance is around $800,000. He has projections showing that if he keeps this up until 65, he retires with somewhere close to $2 million. Dave has every reason to feel good about this. By virtually every conventional retirement savings benchmark, Dave is winning. But Dave has never asked one specific question, and the answer to that question is going to change the math of his entire retirement. The question is, what will my effective tax rate be at 73? Most people assume retirement means lower taxes. You stop working, your income drops, you slide into a lower bracket. That logic is correct for people with modest balances. It breaks down for people who saved seriously and followed the advice to pile everything into the traditional pre-tax account. The mechanism that breaks it is the required minimum distribution. You must take your first required minimum distribution for the year in which you reach age 73. However, you can delay taking the first RMD until April 1st of the following year. This means you have to start withdrawing money from these accounts on a schedule set by the IRS. Once you turn 73, if you were born in 1951 to 1959, or once you turn 75 if you were born in 1960 or later, a required minimum distribution is the amount the IRS forces you to pull out of a traditional 401k or IRA every year once you reach RMD age. You do not get to choose whether to take it. The calculation. A RMD is calculated for each account by dividing the prior December 31st balance of that retirement plan account by a life expectancy factor that the IRS publishes in the Uniform Lifetime Table. At age 73, that divisor is 26.5. Dave retires at 65 with $2 million in his traditional 401k. That account keeps growing. If it earns an average of 5% per year from 65 to 73, the balance at first RMD is roughly $2.9 million. His first required minimum distribution, $2.9 million divided by 26.5, approximately $110,000. This lands on his tax return as ordinary income, every dollar. Not as capital gains, not at a preferential rate, ordinary income. Many people save in traditional 401ks and other tax-deferred vehicles, assuming that when they start withdrawing money in retirement, their income tax rate will be lower. However, it's not unusual for retirees to find themselves in the same or even a higher tax bracket when required minimum distributions kick in. Now add Social Security. Dave collects roughly $40,000 annually. The IRS taxation formula for Social Security benefits, written into law in 1984 and never updated for inflation, means up to 85% of his benefit becomes taxable once combined income, crosses a threshold that has not moved with the cost of living in 4 decades. Dave's modified adjusted gross income, call it $110,000 plus a large portion of the Social Security. He just crossed something called the IRMA threshold. For 2026, Medicare beneficiaries who earn over $109,000 a year and who are enrolled in Medicare Part B and or Medicare Part D pay the income-related monthly adjustment amount, which is a surcharge added to the Part B and Part D premiums. In annual dollars, the Tier 1 surcharge is $1,148 per person, combining Part B and Part D adjustments. That number seems manageable in isolation. Then you account for what happens next. RMD divisors shrink every year while balances continue to compound. So RMDs commonly trip the first RMAA bracket between ages 75 and 77. By 77, Dave is likely in Tier 2. Once tripped, combined Part B and Part D surcharges run $1,148 to $6,936 a year on top of the standard premium. And if Dave is unlucky enough to still have a large balance late in retirement, at 85, the Uniform Lifetime Table divisor has shrunk to 16. His RMD is now 1/16 of whatever the balance grew to. The waiter doesn't ask what you want. The waiter brings the food. IRMA is divided into income brackets, and once your income crosses into a higher bracket, your surcharge jumps to the next level, sometimes by a meaningful amount. Even a small increase in income near one of these thresholds can have an outsized impact. Go just $1 over a bracket boundary, and you owe the full surcharge for that higher tier, not a prorated amount. $1. $1 of extra RMD income can cost you over $1,000 in additional Medicare premiums. The 2-year look back means a 401k withdrawal decision made today affects Medicare premiums 2 years from now, a connection that is easy to miss in standard retirement planning. This is the open tab. The bill doesn't arrive when you put the food on your plate. It arrives 2 years later, with a surcharge you didn't budget for. If you don't take any distributions, or if the distributions are not large enough, you may have to pay a 25% excise tax on the amount not distributed as required. The IRS does not leave this to chance. By the way, hit subscribe if you're finding this useful. YouTube's algorithm has a demonstrated talent for hiding this channel from the exact people who should be watching it. Knowing these numbers exist and structuring around them are two very different things. I spent years working through the actual after-tax, after Medicare, after RMD numbers with people who saved diligently and found the open tab waiting for them anyway. I built something to address this. It's called the Exit Code. It's a digital book, 8 chapters, built on 50 years of actual retirement data. Not the vague confidence of a general financial plan. Math. 2 things from the book I want to flag for this specific video. First, there's a section on what I call the 4% trap. The 4% withdrawal rule comes from a 1994 study. It was not designed for the interaction between RMDs and IRMAA, for current bond yields, or for 30-year retirements. The book breaks down a dynamic withdrawal method that adjusts for sequence of returns risk and keeps your withdrawal rate responsive to real conditions rather than a static assumption from 3 decades ago. Second, there's a chapter on the lazy portfolio, a structure that has historically outperformed active trading over 30-year windows, requires minimal maintenance, and works across account types to minimize the kind of RMD stacking we've been discussing. If you're trying to manage your MAGI in retirement, the vehicle your assets sit in matters as much as the assets themselves. The Exit Code is available through the link in the description for less than 1 dinner out. Every year you build the wrong structure around the right intentions, the tab keeps growing. The math on that compounds faster than most people expect. Now back to the architecture of the problem. Because the fee drag and the RMD tax bomb are actually the wrong frame for where the real money is being lost. You think the problem with the 401k is that you're not contributing enough. But for a meaningful number of disciplined earners in this audience, the real problem is that they've been over-contributing to the wrong account type. It isn't insufficiency, it's structure. Here's why that matters on the withdrawal side. When you pull money from a traditional 401k, every dollar is taxed as ordinary income. Your entire account balance, your contributions, your employer match, 30 years of compounded growth, it all comes out as income, taxed at 22%, 24%, 32%, or higher, depending on your bracket. When you pull money from a taxable brokerage account, assuming you held the investment for more than 1 year, you pay long-term capital gains tax. For most earners in the 22% ordinary income bracket, that rate is 15%. Taxable brokerage account withdrawals incur capital gains taxes, which are often lower than ordinary income tax rates. As of 2024, the long-term capital gains tax rates are 0%, 15%, or 20%, depending on your income level. And here's the structural advantage that almost never gets explained. In a taxable brokerage, you only pay tax on the gain, not on your principal, not on your original contributions. Those were already taxed when you earned them. In the 401k, you pay ordinary income tax on the entire withdrawal, your original dollars, your employer's match, every penny of compound growth. All of it hits as income. Those pulling money out from a 401k will get taxed at a higher rate for ordinary income. You should also keep in mind that because you don't pay taxes on your 401k contributions, you'll owe ordinary income taxes on the whole withdrawal, whereas taxable account investors will only have to pay taxes on capital gains. The Morningstar analysis put this plainly. The ability to make pre-tax contributions will be more valuable to the investor who's in a high tax bracket at the time of that contribution than it will be to the person who's in a lower tax bracket. Withdrawals from taxable accounts receive more favorable and flexible tax treatment than withdrawals from traditional 401ks. In other words, the tax arbitrage that makes the traditional 401k valuable only works if you genuinely enter in a high bracket and exit in a lower one. If your exit bracket equals or exceeds your entry bracket, which is exactly what happens when disciplined savers accumulate $2 million and then face forced distributions, the advantage evaporates. The open tab comes due at full price. There's a second cost to the 401k that the fees conversation and the RMD conversation both undercount. It's the opportunity cost of locked capital. A 401k limits your ability to access funds without penalties before age 59 and a half. 10% early withdrawal penalty plus ordinary income tax. That's not a minor inconvenience. That's a wall. Because you can take money out of a taxable brokerage account anytime, money saved there can help early retirees bridge the gap to age 59 and a half when qualified distributions from retirement accounts typically begin. But more than early retirement, think about capital deployment at 43, a real estate deal, a business opportunity, a bridge loan to a sibling, a year of consulting you wanted to do but couldn't without income. The 401k cannot help with any of those things without a penalty that roughly equals the tax you would have paid anyway. The taxable brokerage can help with all of them. No penalty, no government asking why you need your own money before a specific birthday. I want to be careful here because this isn't an argument against the 401k. The employer match alone makes it irreplaceable up to a certain contribution level. But the default assumption that you should maximize it to the legal limit year after year, regardless of your specific tax situation, your specific plan costs, and your specific likely bracket in retirement, that assumption deserves scrutiny, and most people give it none. Stay with me, because this is where I give you the actual sequence I use, the one built on everything we've covered. There are 4 buckets. You fill them in order. You do not skip buckets. You do not fill them simultaneously. The sequence matters. The first bucket is the employer match. Your employer's matching contribution is the single highest yield investment available to a working American. If your employer matches 50 cents per dollar up to 6% of your salary, that's an instant 50% guaranteed return before any market movement. No index fund, no real estate deal, no crypto in history has ever reliably produced a 50% guaranteed return on day one. You capture the full match every year, full stop. The second bucket is the one the financial advice industry consistently skips. The health savings account is the only account in the US tax code that offers a triple tax advantage: tax-deductible contributions, tax-free investment growth, and tax-free withdrawals for qualified medical expenses. No 401k, IRA, or Roth account matches all 3 benefits simultaneously. The traditional 401k gives you the deduction going in, but taxes you on the way out. The Roth gives you tax-free growth and tax-free withdrawal, but no deduction going in. And HSA provides a deduction on contributions, tax-free growth, and tax-free distributions for qualified medical expenses. It is structurally the best tax vehicle in the American tax code. And most people treat it as a checking account for doctor copays. For 2026, the annual HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. There's an advanced play here that changes the math significantly. The IRS places no time limit on reimbursing yourself for qualified medical expenses from an HSA. You can pay medical expenses out of pocket today, save the receipts, let your HSA grow for decades, and reimburse yourself tax-free years later. You pay a doctor bill in 2026, you save the receipt. You invest the HSA in a low-cost index fund. 15 years later, you reimburse yourself for that bill from a balance that has compounded for 15 years, tax-free cash, on money that compounded tax-free, off a contribution that was tax-deductible, all 3 legs at once. According to Milliman estimates, the average 65-year-old couple will need approximately $395,000 after tax to cover healthcare costs in retirement. That's Medicare premiums, supplemental insurance, prescriptions, dental, vision, and long-term care. The tax-free compounding over that period is the mechanism that makes the HSA competitive with, and in some scenarios, superior to, a Roth IRA for retirement accumulation. And critically, there are no RMDs for HSAs. The open tab doesn't apply here. The HSA money does not get drafted into mandatory income at 73. You control the timing entirely. The third bucket is the Roth, either a Roth IRA or a Roth 401k if your plan offers it. Contributions are after tax. Growth is tax-free. Roth IRAs don't require RMDs during the account owner's lifetime, and Roth 401k accounts no longer require RMDs after 2024, thanks to changes made in the Secure 2 Act. This is the pattern interrupt most people in their 50s haven't registered yet. A Roth 401k, the same account type you've probably been ignoring at work, produces 0 taxable income in retirement. Every dollar you pull from it is invisible to the IRMA calculation. It doesn't push Social Security into the taxable range. It doesn't drive up your MAGI. It is, for Medicare premium purposes, as if it doesn't exist. Every dollar converted in the 12% or 22% bracket before RMDs begin is a dollar that never shows up in the divisor at 73. Converting $50,000 a year for a decade can knock 20% off the eventual RMD and keep MAGI under the first IRMA tier in retirement. The conversion corridor, the window between retirement and the RMD start age, is where serious tax planning lives. If you can retire at 65 and delay Social Security until 70, you have roughly 8 years of relatively low taxable income where Roth conversions can happen at controlled, lower rates. You prepay the tax at 12 or 22%, rather than letting the IRS force it at 24 or 28 when the RMDs start stacking. The window between 70 and 72 is the most valuable tax planning real estate this retiree owns. The fourth bucket is the taxable brokerage account. No contribution limits, no lockup period, no RMDs. Long-term capital gains rates at 15% or lower for most earners. And if you hold low-cost, broad market index ETFs with minimal distributions, the annual tax drag is close to negligible. Using a taxable account in addition to your 401k can help diversify your tax strategies. That diversification has a dollar value in retirement that most retirement calculators don't capture because most calculators only model one account type. Now back to Dave. Dave heard this at 52. He didn't panic. He didn't sell anything. He made 3 structural adjustments. He stopped maximizing the traditional 401k beyond the employer match. He redirected the excess toward the HSA, $8,750 per year for family coverage, and into a Roth 401k, where his plan offered it. The remainder went into a taxable brokerage account holding a total market index ETF at 3 basis points. No plan administrator cut, no revenue sharing, no 12-bone fees. At 67, Dave's total accumulated wealth is similar to what it would have been under the max everything traditional approach. Maybe slightly lower in nominal terms because some of the contributions went in after taxes, but the composition is fundamentally different. A meaningful portion of his wealth is in a Roth, no RMDs, no MAGI impact. A meaningful portion is in the HSA $300,000+ of tax-free healthcare purchasing power. The taxable brokerage produces long-term capital gains at 15%, not ordinary income at 24%. His retirement MAGI, pulling the same total spending amount, stays under $109,000. He doesn't trip IRMA. His Social Security is minimally exposed to the taxation formula. His Medicare stays at the standard $202.90 per month. The difference in cumulative tax burden between Dave's original path and Dave's revised path over a 20-year retirement runs well into 6 figures. Same contributions, same discipline, different structure. That's the whole game. Not a better return, not a smarter allocation, a structural difference in how the same dollar is treated at withdrawal. Let me give you one more concrete scenario. Marcus is 42. He earns $130,000 annually as an engineering manager at a mid-sized manufacturing firm. His employer matches 3% of salary. His plan's total plan costs run about 1.08%, consistent with what a $5 million plan typically pays according to the 401k averages book. Under the conventional approach, Marcus maxes his traditional 401k at $24,500 in 2026. Over 25 years, at 7% gross return, with 1.08% in total fees, the net return is approximately 5.92%. His balance at 67, roughly $1.6 million. The gross number would have been closer to $2 million. The fee drag over 25 years at that contribution level consumed approximately $350,000 of compounding. Under the alternative stack, Marcus captures the employer match about 3% of salary, roughly $3,900 from him plus the match. He maxes the HSA at the family rate, $8,750 per year. He routes another $10,000 per year to a Roth 401k. The remaining contribution capacity goes to a taxable brokerage account holding a total market index ETF at 0.03%. Same total annual savings effort, different account composition, different fee exposure, different tax treatment at withdrawal. At 67, Marcus's total portfolio value is roughly comparable. But in retirement, the after-tax purchasing power of that portfolio is materially higher. The Roth money produces zero MAGI impact. The HSA covers the $395,000 in projected healthcare costs tax-free. The taxable account produces gains at 15%. Only the small traditional 401k, the piece that captured the employer match, generates ordinary income. Marcus's MAGI stays manageable. His Medicare premiums stay standard. His Social Security benefit faces minimal taxation. Over 20 years, the structural tax difference between these two approaches, same contributions, different accounts, lands in the range of $150,000 to $200,000 in reduced lifetime tax burden. That's not a rounding error. That's several years of living expenses. One other thing nobody in the HR department mentions, the 10-year inherited IRA rule introduced by the Secure Act means your heirs, if they inherit whatever you leave in a traditional 401k, must drain the entire account within 10 years of your death. Every dollar comes out as ordinary income. Compressed into a decade, the account you built as generational wealth becomes a concentrated ordinary income event for your kids. A Roth IRA avoids that problem entirely. The heirs still face the 10-year rule, but the distributions are tax-free. The financial advice industry built the max your 401k heuristic for a world with shorter retirements, simpler tax structures, and smaller account balances. A 1% annual fee difference can reduce a retirement account balance by 30% over 40 years compared to a low-fee alternative. Compound that with an RMD tax situation that pushes retirees into the same or higher brackets than their working years, and you have an advice framework that was optimized for 1985 and deployed unchanged into 2026, the world that advice was written for no longer exists. The open tab stays open longer now. The waiter is more aggressive. And the surcharges were written in 1984. All right. 3 specific things, not general, calibrated to exactly what we covered today. First, get the total fee number for your current plan, not the expense ratio on one fund, the all-in cost. Ask HR for the 40405 fee disclosure document. Add investment fees, administrative fees, and any revenue sharing arrangements. If that number is above 0.5%, you are paying a small plan premium that compounds against you. Run the Truthify ICI modeling on your own numbers. A 1% fee difference on a portfolio of your size at your contribution rate over your remaining years will produce a number that makes the disclosure request feel extremely worthwhile. Second, before you contribute another dollar beyond your employer match into a traditional 401k, project your first RMD. Take your current balance. Apply a conservative growth rate, 5 to 6% until you hit 73. Divide by 26.5. Add projected Social Security. Check whether the combined number approaches $109,000 for a single filer or $218,000 for joint filers. If it does, you have an IRMA exposure that can only be mitigated through actions you take now, primarily building Roth and taxable assets to reduce the proportion of your wealth sitting in the traditional pre-tax account. Third, if your employer offers an HSA-eligible health plan, fund the HSA before routing any additional dollar beyond the employer match into the traditional 401k. $8,750 for family coverage in 2026. Invest it in a low-cost index fund. Pay your medical costs out of pocket if you can. Save every receipt. There is no time limit on reimbursement under current IRS rules. The triple tax advantage compounds. The 401k's single tax advantage does not. None of these require market timing. None require complex trading strategies or exotic instruments. They require running the stack in the correct order and stopping the default assumption that more in the traditional 401k is always better. Lazy investing built more fortune than crypto memes. The people who figured that out weren't the ones who hit the maximum contribution limit every January. They were the ones who asked, what does this money look like after the IRS gets their cut? Then they built accordingly. The tab is always open. The question is just when it closes and who sets the prices.